Yeah, I'm losing
When you
my
start
edge.
trading, any reason that anyone starts trading, there's probably three reasons you want to participate in markets and three ways you can use the small exchange products to participate in markets. You can invest. If you're a passive investor, you probably have a 401k or an IRA or an investment portfolio that you just buy Apple or whatever you decide to do. You can speculate, which is what we would call active day trading or swing trading or just any trading really. And you can hedge, which is you have an existing portfolio, you want to remove some exposure, you're not sure if the market's going to correct here, you want to protect yourself. Smalls fit all of these buckets, I would say. But today, in particular, I want to focus on speculating with small exchange products, actually trading it, getting
Right.
your hands on the keyboard, seeing what's moving like we do with big movers. You know, we talked about small stock 75 down this morning, now up, how to capitalize on some of those opportunities.
Fantastic. And you know what? You're right. There's lots of different ways to implement product, but this is an exciting way. This is a way you learn, and I think it's part of the process of hedging is a natural piece. We all do investing. The 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 ability to start to understand how to employ product on the speculative side, I think, gives your ability to invest and hedge. One, I mean, you can either argue over passive or active actions.
Mhm.
You become better at doing that, understanding this piece. So this truly is, you think, well, I'm not a risk taker. You're not. What you're building out is mechanics and strategies that will let you accomplish all three goals.
Exactly. These are not in any way mutually exclusive.
Right.
They should be used in conjunction with each other. So first, let's talk about products. I mean, we're talking about speculating with the small. So what are some of the products that we have available to us? I've put three here. We do have a fourth product, the Sticks, which is trading actively each and every day. It's a very fun product. It's engaging. It's all the tech stocks that you know and love, basically. But I'm highlighting these three here today. So SFX, US dollar exposure. SPRE, precious metals exposure. SM75, stock exposure. We look at the notional values of each of these products. To compute the notional, you look at the stock price or the futures price, you multiply it by 100, and then you look at the actual cost to trade. So you're putting up $170 to trade SFX, 440 for precious metals, 560 for SM75. This is determined by the brokerage firm. So these are Tastyworks margins here we're looking at. But what I want to highlight is that percentage of cost, percentage of value that you're actually using to trade. It's really never been cheaper, I would say, to participate in markets than it is right now with small exchange products. You're talking about $175 for USD exposure. That's pretty darn competitive in the space, I would say. And that's going to enable you to not only trade dollar, but also maybe add some precious metals exposure, maybe add some stock exposure, build out a holistic portfolio, whether that's investing, speculating, or hedging, and engage in a variety of markets. So I think that's important to understand when we start the conversation here. So the margining behind smalls is going to let, I would say, more people participate in new and inventive ways. But before we participate, I think it's important we set some expectations. And this is where the strategy comes from. Here we're looking at the SFX, the small US dollar. It's what we're going to focus on today. If you looked at that chart, you see it moving from 148 to 164. How would you determine any levels from this? Could you set profit expectations just looking at this line chart?
Mike, it's a great question because this is the question everybody asks, and it's asking half the question. If you're going to be speculating, you've got to ask both sides of the question. How do I set profit expectations and how do I set loss expectations? Because without them, your mechanics aren't complete. If we're going to use static deltas, which is what futures are, which is what we have here on a much smaller scale, which is wonderful, we're going to have to set expectations around both sides of that equation. So no, the great temptation is to draw a lot of lines and some other things. Now, if technical analysis in its form works for you, and it's part of your mechanics and isn't your overriding decision-making tool, Wonderful. You know what? Nothing gets excluded from a strategy basket because somebody says it's not worthwhile. If it works for you, you keep it in there and you keep using it effectively.
Mhm.
Um, no. So the looking at this, it's like, wow, there's a lot there. There's a 14 handle move. That's a $1,400 move. I knew that that's easy to figure out because it's dollar wide ticks here. So I honestly, if you brought up a silver chart, I'd have to. I would need 20 seconds to do the math, and it's not because my brain is I have no short term memory. I don't have any short-term memory, but that would still be the issue of calculating. This is the elegant simplicity of dollar-wide ticks across the entire product suites. But no, Mike. So, how do I start to adjust expectations and those two-sided expectations? It's tough to say here. So, how do we start to build? So, strategy here. You can pick either side here. Boy, it's been we could go back to June and say, heck of a down move, but maybe there's some more room to be done on this dollar weakness. Or you can look here at the 150 level. Boy, we've had an incredible run of dollar weakness, currency strength. Maybe it's going to turn. Well, we've got almost a 200 plus point turn. I'm sorry, $250 turn from 148 to 150 and a half. Maybe dollar keeps selling again. So all these different pieces line up as I can look at this and see there's trade opportunity, but how do I put scope around it, manageable scope? And that's going to be the important part here.
Yeah, we need to peel back some layers here because
Right.
I kind of maybe I set you up for this one, but this is a closing chart. So we're not even looking at the intraday opportunity, but we also, in my opinion, need to look at some numbers. You mentioned silver. Silver is an inexpensive looking future.
Yeah.
What I mean by that is the price is where are we
Right
at?
up to it isn't. Yes. $23 right now.
It looks cheap, right? And when I started trading futures, I thought, oh, this is great. But actually, it's more volatile than gold, and those tick values certainly add up when it's moving against you or with you. But what I want to do is peel back the curtain behind the chart and add some statistics to our trading. And this is really what I think trading is all about, and that's strategy, using a
Mhm.
little bit of math. I'm not a math major. Frank's a math major. I'm so jealous. I wish I was.
Alleged,
Oh,
alleged math major. We have actually never seen that diploma. So you and I are both good-hearted guys. We're willing to take a man at his word, but at the same time,
I've seen that guy do some math,
I
and
know.
it's right. A equals B all the time. So, but I think using just a little bit of math, we can make more informed trading decisions. And what we're looking at here is the historical movement. We can't predict the future, but we can look at historical data to aid in our decision making. The historical daily, weekly, and monthly movements for each of these small exchange products. So basically, what we're saying here is about 68% of the time, the day-to-day dollar move in SFX is $50 or 50 cents if you're looking at that future.
Sure.
Remember, it's a $100 multiplier. So we've taken this chart, which was end of day closing prices, and we've kind of zoomed in a little bit to see how much these products move on an intraday basis. And it's important to know this because we can then set expectations, either positive or negative, winning expectations or cutting your losses
Right.
expectations now when we're day trading, when we're speculating.
And you know what? Absolutely. And you know, um, what's great about this is that these do change over time, and going back and determining what these are in terms of this average daily movement is a great place to start, because I think we can go back and say that, what's a traditional day, what's a non-traditional day, and the non-traditional day sits outside those bounds, and statistically that's where the opportunity lies. So what's a normal trading day? Do I want to trade the bounds of a normal trading day, or do I, statistically the numbers don't lie? Just as you said, the math the math doesn't hide anything. To understand that is an important component around gauging expectations. I think the hardest thing traders have to do is either adjust expectations or get comfortable around expectation set. It doesn't look like silver can move $5,000 in a day. It's only worth $22 an ounce. Well, you know what? You have to accept the numbers behind that. That's uncomfortable for everybody, including me. So I think having this foundational framework, and the idea is this isn't uniform across all products, but to have this in your toolbox is an important tool to start to set up the table around where opportunity lies. So this is great, Mike.
Yeah, I don't think we should ever be comfortable with these numbers per se. I mentioned Nassim Taleb yesterday. He's a big tail risk guy. So there's obviously the potential for things to move beyond the average. And we've certainly seen that the last few months with heightened volatility. And maybe we'll see it going forward as we approach this 2020 election. But at least having a baseline, I found it at least to be extremely helpful. And this is extensible. I mean, you look at the daily movement in SFX $50, but you can actually increasing the amount of time between days. You can say, all right, on a weekly basis, moving about $100, and you can almost better curate your risk return profile just with a little bit of math. And you'll see here, I'm going to go back a slide real quick, but the percentage of capital you need to outlay is roughly proportionate to the amount of risk, and that's because of the margining methodology behind futures. So we talked about silver prices. I mean, SFX, larger notional value than precious metals, but because of the lower daily movement, it requires less capital on an intraday trading basis. So just a little factoid there. I don't know how helpful it really is, but
It's tremendously helpful because what you did is you took the concept of what they call span margining, the world of futures margining, and didn't use the word span, which probably confuses, and just kind of complicates the process.
I don't know what it even stands for.
Okay, let's see now. It I know what it is, but it's like, why am I going to be like, I don't need to.
Don't confuse anyone.
No, but that's what I want to avoid the proclivity of running down a rabbit hole. But you're absolutely right. And and it's the old thing. Knowing what SPAN stand for is never put $1 in your pocket. But
Exactly.
what you did is explain that the margin, the dynamic nature of margin in the futures world is determined by movement. And so it needs no more explanation than that. So it was a great explanation.
So let's take a quick look at maybe visually, because I know some people are numerical, some people are visual learners. So I just wanted to put this in a little more context, looking at the dollar as well. This is kind of what we're talking about when we mention these historical daily moves. So these values that I referenced on the previous table can be used as a reference point before entering or exiting a trade. And this SFX circle is it's not to scale. I'm not saying that we're this close to one standard deviation away on the dollar product today. But the way you would use this, I would say, is the average on a traditional day, we would expect dollar to swing maybe $50 to the downside or $50 to the upside. And when you're deciding whether to enter a position or take your profits, that's how you use these numbers as a guide. If dollar is, in your opinion, overextended, maybe it's down or up more than $50, and
Right.
you want to form an opinion basis that level that it's currently trading at.
Yeah, and there you're adding, you know what, you're taking, which is great. You're taking probabilities and assigning, a context around them rather than what we did for some, which spitball is, well, I'm used to seeing the market trade 80 ticks in a day. If it's an inside day, it's less. This really is, where we've come so far as traders to be able to put these statistical tools in front of ourselves to enhance our opportunities and actually help us. This is an important concept, not only in mechanics, but in building strategy. So it is something that is one of the foundations when you go through your daily exercise of looking for opportunity and levels of interest in where you want to participate in the market. It's an important tool in that component. So I think it's because what this does is, Mike, when you do this, you talked about none of these numbers are static, they move.
Mm-hmm.
Well, the concept of a one standard deviation move is the consistent part of that dynamic nature. So that becomes your anchor for adjusting those expectations around whether it be $40, $50, or $75. So this is, the perfect way to talk about starting to speculate and how do I build the tools around doing that.
Yeah, you want to go in with a strategy
Right.
before you just start clicking buttons. buy and sell. And like we talked about this week too, managing your losers and knowing when to call it quits is just as important, if not more important, than managing your winners. So having a baseline for that is going to be crucial. So finally, taking us home here, I just want to plug the small exchange products one more time and comparing them to some of the other options on the market. And in my view, for less cost, I think there's some really nice opportunity with small exchange products in terms of the flexibility that they afford. So we have, a few columns here. We're looking at an ETF called UUP, which I've traded before. It's notoriously difficult to trade. It doesn't move. Like, I swear, 6 years ago, it was at the same exact level. And a lot of stuff has happened in markets over 6 years. Comparing it to 6E, which is a Euro FX future, and then the SFX, you look at this value column on the far left. For UUP, it's 100 shares of UUP. It's a notional of about $2,500. You look at the traditional Euro FX futures, which, Pete, I know you're familiar with, being on the floor. You've traded these contracts probably thousands, if not tens of thousands of times. $145,000 notional exposure. And then somewhere in between is the small dollar product, which is about $15,000 in exposure. You look at cost, the next column, UUP, you're putting up 100% of that cost. It's just the way ETFs are margined, unfortunately, either 50 or 100% of that cost. With Euro FX or SFX, you're getting that futures capital efficiency. But then finally, you look at the dollar daily move. You have to decide what is okay for your portfolio, what is okay for your risk appetite, your expectations in trading. And I think you basis your decision on the numbers, not gut feeling, but having an idea of how much things move, what they cost for you, and your existing portfolio exposure.
Absolutely. And you know what? It is a product construction and the amount of resources, and always when we talk about resources, it's capital we need to use to implement them, is one of the most important strategy decisions we make. And that's what brings everyone to futures, is this efficiency you gain in being able to express a number of opinions in a very efficient manner. Efficiency then leads to an increase in your return on capital. Both those do. The trade-off has always been, I get all those benefits, but I get like the Hindenburg jammed down my throat in terms of the size of the trading I'm having to do in terms of product. That amount, that challenge is something that we've really addressed and continue to address here. And, $50 is, it's so funny in context. I think a $50 scalp, it's not that much. But on an intraday basis, posting $50 to scalp a range of $50, it has actually 50 unique price points to trade in and out of, unlike UUP, which may give you 8 or 9. There's a lot of interest. And what's the answer to making the $50 bigger? It's adding another unit. It's not having it's scalable within your strategies, within your mechanics. That's such an important piece that was never afforded to self-directed retail traders like you and I. We had to live in this big world, and trust, every time you went to get bigger in that big world, you would think, well, I'm making this trading 5 lots. Geez, if I traded 10, it would just make twice as much. Mm-hmm. I think we all know from experience that doubling your size never is. Your behavior and your mechanics don't necessarily hold up to that. So it's so important when you adopt new product and go for, people who have never thought about trading a dollar. This is a place where you can learn, live, and scale as you find constructive strategies. So I love, this is just a very elegant walkthrough of, here are 3 different opportunities. You can judge the quality of the products. You can judge the amount of capital you use to contribute to them, and you can build strategies around them. I think they do highlight exactly what we're trying to do at the small exchange in a very productive way.